How much gains have NVIDIA pulled forward? That's like the $1 trillion question. They're creating a new category that literally out of thin air that didn't exist. So is it expensive? I don't know, probably. Is it a bubble that has to pop?
And if you're a super data nerd, go to worldofdaas.com. That's DAAS, worldofdaas.com, and sign up for our weekly Data as a Service news roundup newsletter. Hello, fellow data nerds. My guest today is Michael Batnick. Michael is managing partner and director of research at Ritholtz Wealth Management. He's also the host of several awesome podcasts, including Animal Spirits, What Are Your Thoughts, and The Compound with Friends. Michael, welcome to World of DAS.
Thank you so much for having me.
I'm really excited. Now, we're recording this at the end of March. I think crypto is like an all-time high. The stock market is roaring. I think NVIDIA added like $275 billion in a single day in February. Interest rates are nowhere near zero. So what the heck is going on?
Where do we begin? It turns out that the world didn't end. And in fact, the opposite happened. We survived 500 basis points of rate hikes. Of course, not everybody survived. There are certain areas of the economy that are in trouble. But by and large, the royal we made it through. The economy is growing. Inflation is cooling. People are spending. The stock market is working. And there's not a gigantic disconnect between the market and reality. A lot of people think there is, but there's not. It's not to say that the market isn't like maybe a little bit frothy or extended or ahead of itself or anything like that, but it's not in a bubble. We learned today that the fourth quarter GDP got revised up to a 3.4% annualized rate.
Which is crazy fast for an economy of our size, right?
Not bad. Delta said that they're having record bookings. You're seeing the same things from cruise lines. Las Vegas this morning, we found out gambling was up 12% year over year. These are the sort of things that happen when the economy is doing pretty well. Yeah. Discretionary spending is there despite the inflation. So how did we get here? Yeah, listen, this was not on my bingo card. In 2022, I certainly thought that there was going to be a recession. Now, in 2023, I probably, like a lot of people, didn't really believe the rally. AI certainly had something to do with it, a big part of it. But yeah, here we are. It's been a hell of a run.
What is the reason, like what's the logic for now, like lowering interest rates? Like it seems like things are fine. Like wouldn't you want to lower them to do some more stimulants or something like that? Like why lower them this year then?
I'm with you. And the market is with you. The market keeps pushing out the forecast for the first rate cut. I think at first it was March and now it's June or July. So I am with you in the sense that the economy is humming. We have digested these gains. Why lower them now? Why do anything to potentially spark more spending
and more inflation? Yeah,
and
plus then you save you only have so many bullets of lowering. You save that for when we really need it later.
The reason for them to lower rates, in my opinion, is to save the housing market. First-time home buyers are sidelined. People that are trying to leave or trying to move are sidelined because it's really difficult to give up a 3.5% mortgage rate.
Yeah.
So it's the housing market. Outside of that, I don't know why they would be in any rush, and they're not.
Yeah.
To lower rates.
Yeah. Got it. I guess you could potentially, offer low interest loans to first time home. But there could be other ways that, like as a society, we could help those people or something like that. Yeah.
Well, yes, there is. The Fed could start buying mortgage bonds if they wanted to get involved in the housing market. I guess like the economics answer, and I'm not an economist, would be that rates are high and interest rates keep falling. I'm sorry, interest rates. Rates are high and inflation keeps falling. And so that the real rate, like why keep things restrictive? But does it really feel like they're restrictive? Like let's use some common sense. Like given everything I just said, given the market's reaction, given consumer spending, does it really feel restrictive anywhere outside of commercial real estate?
Crazy frothy right now. And what is driving what's driving the market? Is it retail investors? Like what is driving it?
So so untangling where like the gains and flows are coming from is a little bit tricky, but what's driving it, again, I have to like center this back to the fact that it's fundamentals. Corporate profits
are good. Yeah.
Corporate profits are at an all-time high. There's no like conspiracy, like who's doing this? Guess what? Corporate profits are at an all-time high. The stock market follows earnings. These
Yeah.
are businesses. And when the businesses are at an all-time high in terms of earnings
Yeah,
and
and they're probably not
margins,
trading as a ratio against their earnings. They're not trading that crazy because their earnings are so good. Yeah.
it depends what markets you're looking at.
Yeah.
But even something like Nvidia, which is like certainly how much gains have Nvidia pulled forward? That's like the $1 trillion question.
Hello, fellow data nerds. If you're enjoying this episode, please hit that subscribe button. I would super appreciate you being a subscriber to World of DAS. Now, back to the episode. Yeah.
It is 80% of this legit and 20% is fraud? Is it 20% real and 80% fraud? I don't know. What I know is that, listen, look at Nvidia's numbers. They're wild, right? Like the earnings growth has been explosive.
Amazing.
They're
Yeah.
creating a new category that literally out of thin air that didn't exist. But if you look at like where they're trading next year's earnings, the stock is cheaper today than it was a year ago because the earnings have grown so much. So it's 35 to 40 times forward earnings insane for a company that's growing like this? Where should it be trading, right? Should it have the same multiple as a Colgate Palmolive? Of course it shouldn't. So is it expensive? I don't know. Probably. Is it a bubble that has to pop? I don't think so.
And
It can, but it doesn't have to.
if you're just an average, person saving from their retirement, like should you be thinking about this? Should you just like not even worry about it and
You
just kind of
shouldn't
like
be.
follow your strategy? Or
You shouldn't be thinking about it. There are people who get paid lots of money to spend their every waking second thinking about it, and you should not be competing with them, right? You wouldn't step on the field, you wouldn't step on the football field and try and go over the middle. You wouldn't step on a basketball court. Like these are actual professionals, and what the normal person should do is divert their attention to things that actually can move their needle, like improving their career situation,
Yep.
learning, friends and family. Like the goal in life is not to be at the stock market. So it is a distraction at best and counterproductive at worst.
So someone has like under a couple $1 million of investable assets. Should they even be spending any time at all thinking about it? Because or how should one be thinking about some of these things, like their own investing strategy?
If you enjoy the market as a hobby, that's one thing.
Yeah.
If you are just a normal person outside of finance who's contributing to their 401k, maybe you've got a taxable brokerage account that you're dollar cost averaging into, you should spend less than, pick a number, 2 hours a year thinking about your investments.
Yeah.
You should be working as hard as you can or as hard as you want to save as much money for the future, because the market goes up.
You can lower your costs of living. Probably helps you way more than any investing you're going to do.
Yeah, I'm not a big fan of lowering your cost of living.
Okay, or getting more higher raise instead of getting a 6% raise. You work hard and you get a 9% raise.
Yeah, that is where you should spend, as far as like your personal finances go. That is where you should spend your time, not thinking about should I have 5% in micro caps or small cap growth. Like that's not the thing.
And for a lot of people, it's almost like investing is less investing is more just like a saving strategy. I'm going to put certain amount of a year away for saving, for a rainy day fund, for my retirement, for my kid's wedding one day, whatever. It's that type of thing.
That's exactly right. People say I'm saving for retirement in my 401k. Yeah. You don't say now it's splitting hairs, it's nomenclature, but people don't say I'm investing for my retirement. They say I'm saving. So your retirement account is a savings vehicle. And what has that done to markets and market structure? And it's not a stretch to think that has had some influence on asset prices. Now, it's not to say that the market is divorced from reality, because again, it's not. All-time record highs in profits and earnings. Stocks should be at all-time highs. That is rational. That's how the market works. But stocks are trading with higher multiples than they have in the past. And it's not just for one reason. It's not just because people are auto investing every 2 weeks. The nature of the stock market is very different today. And does it sound like this time is different? Yeah, you're damn right it's different. Amazon, Apple, Google, these companies. Now, there were other versions of this earlier, but none of them were this size, this innovative, this dynamic, this dominant with these margins at a sustainable rate. These companies didn't exist in the past.
How should we be thinking? I mean, this enormous weight of these mega caps in the U.S. stock market, like, is that a bad thing, a good thing? Like, how should we be thinking about it? Because so many people's wealth is tied into like an S&P 500.
Yeah. So here's okay. It's not a bad thing. These companies make up the lion's share of earnings and earnings growth They are the dominant companies. They deserve a dominant weight in the index.
Yep.
And I'm not a blind both, by the way. So I want to preface it with this. Like I'm not like somebody who doesn't see downside risk. It's all I think about is the downside. That being said, I would be nervous. In 1999, if you looked at the internals of the stock market, meaning look at the 500 companies, not just the index,
Yeah.
what you saw is a lot of companies rolling over, meaning that they were in drawdown, the price was going down, but the index was being propped up by the Ciscos of the world. Okay.
Yeah.
If that
Even
situation
GE at the time was doing incredibly well in 1999.
Yep. If that dynamic were to exist today, where you had the rest of the market rolling over and it was just Nvidia and AMD and Meta, I would say timeout, right? Like I would let my listeners know that maybe we should mentally prepare for a pullback. That's not what's happening now. The rest of the market is rallying too. Materials, industrials, things that are very tied to the economy. And Capital One and Discover, companies that are very exposed to the consumer. If you listen to earnings calls, Visa, MasterCard, Bank of America, the consumer is doing really well. And the broader economy and the broader stock market is doing well. So is it a bad thing? Not right now, it's not.
What explains the disconnect? Because yes, people seem to be doing really well. Yes, the economy seems to be doing well. But when you ask the person, the man on the street, it doesn't seem like people think things are as amazing as they are. So what explains that?
All right, there's a few things. One, it's not a mystery, it's inflation. People really don't like higher prices. So what you're describing is the gap between soft data, which is surveys, like how do people feel versus how the data actually is. And there's a gap. Usually they track one another pretty closely. The gap exists for one primary reason. It's inflation. People hate higher prices. And even though real income has outpaced inflation for a lot of workers, it doesn't matter. I deserve a raise. I'm working my ass off. I deserve a raise. I don't deserve higher prices.
Right.
And you adjust very quickly to your pay raise, right? Like, it's cool. Great. I got an 8% raise.
I'm going to buy that really nice TV I've always wanted.
Yeah, exactly. The sugar high from the raise, you get used to it really quickly, but you can't get over the fact that every week when you go to the grocery store or you go buy a bowl at Chipotle, you can't believe the prices.
I mean, airline prices are just through the roof.
Right.
It's just insane.
So it's really difficult. Also, surveys are bullshit. So there's that as well.
Okay.
I've always been an anti-survey guy. I just don't think that they tell you anything. Don't ask people how they feel. Watch what they do. Watch what they do, not what they say. And people
just look at the data.
Look at the data.
How they're doing things.
It's right. Again,
if they were really worried about it, they would be cutting back their spending.
They'd pull back. Right? Look at what people are spending dining out. Look what people are spending on the airlines, on cruises, in Vegas, on vacations. This doesn't happen in a lousy economy. And nobody's saying that the economy is lousy, but it is interesting now. Consumer sentiment is ticking up. And again, that's directly a result of inflation coming down. That's all it is. Consumer sentiment is right now basically 100% correlated to inflation going up or down. That's it.
Interesting. And anything about like crypto, we've had these like Bitcoin ETFs for a few months now. We're seeing like very high trading volumes. How does the ETF affect the price? Is it going to affect the price? Like how should we be thinking about that?
Yeah, so let me just share where I come from as a crypto investor. Maybe some biases in here, just so the listener some context, because this is a very polarizing area. I was not an early adopter. I don't believe in a lot of the ethos of crypto, that the Fed is destroying our currency. I don't like betting against America. It seems like a lot of the evangelists seem to want crypto to replace the dollar, seem to like the idea of inflation and all that bad shit happening. I don't ascribe to that. In fact, I hate it. And so in order to protect myself from feeling rage if Bitcoin went to $100,000, I bought Bitcoin as a personal hedge.
Okay, got it.
As a personal hedge
when you bet on the team you hate to win because
That's exactly right. So as a hedge against myself going insane, I bought crypto in 2020. Okay. So with that being said, crypto is, or I'll use Bitcoin specifically. Bitcoin is a religion. And if you look at the number of active wallets or the number of sellers, like, people don't sell. I think something like 70% of the Bitcoin supply hasn't moved over the last 12 months. people that really believe, really, really, really believe.
Mhm.
And so when you had the ETF launch, I did not believe, and I wrote this down, so this is not hindsight. I did not believe that it was going to be a sell the news event. I think a lot of people did because the run up was so severe into it, and you got a little bit of a sell the news. But here we are back at all time highs, and the reason why is very simple. The way that I think about Bitcoin, just from an
Just
investing
no
perspective,
sellers and new buyers, essentially.
it's supply and demand.
Yeah.
That to me, that's all I think about it. I don't think about it through the lens of monetary supply or M2 or any of that stuff. I just think about supply and demand. And the light bulb moment for me was with the great investor Bill Miller said, like, Bitcoin supply is coming on the market at whatever, 1.5%, 2% a year. Do you think demand is increasing slower or faster than that? I was like, that's all I need. So that's where we are. I am a bit surprised that we're not so far removed from the mania of 2021, and that we've got the meme coin mania again.
Yeah.
Like the fact that we're meming again so soon after we had inflated and burst that bubble, that surprises me.
In the Bitcoin, like it is, most people I know, when I ask them, like even very wealthy people, when I ask them how much Bitcoin you have, the most common answer is zero. Most people have zero. A small number of people. It seems to me like it'd be prudent to have like at least a tiny piece of your portfolio in there. It seems like it's often either zero or like a ton. It doesn't seem like there's a lot in between. Why is that?
I think rightfully so. A lot of people have been thoroughly put off by the crypto bros.
Yeah.
I think the perception, I think they've earned that perception given all the grift and the FTX nonsense. And now I definitely I'm not suggesting that there aren't good people earnestly trying to build a better future and all that sort of stuff. But there's just way too much bullshit. And I think people were really scared off by the FTX debacle, and it was an absolute debacle. So I don't know if those people are ever coming.
Well, to me,
I
that
don't know
might be the case with the ETFs. It's like, well, now it's like you don't have to go open like a Coinbase account or something. It's like,
it's easy. Yeah.
Okay, I'll put 0.1% of my wealth, and whatever. I'll try it out. I'll see what's going on. I'll learn. Maybe it forces me to learn a little bit more about it. So that may just like it just expands the number of people. Because sometimes I'll ask someone's like, I have nothing. I'm like, why don't you just buy like $20 and see what happens? Like something that won't affect you at all. And like, oh, it's kind of annoying or it's too hard.
Are you a big Bitcoin guy?
I'm not a big Bitcoin guy, but I like it.
Yeah.
I'm not like a huge believer, but I own some. Like I've owned some for quite a while, and it's something that I don't know what to think about it, but I feel like if you're in tech, even with tech people, most tech people own zero. I feel like if you're in tech, it's like, why don't you just try it out and see, even if it's a tiny percentage. All right. Well, this is a data podcast. And what are your favorite metrics when it comes to look at just evaluating the economy?
So I'm going to give you a cop out of an answer. Well, a lot, and not a lot of esoteric ones. The economy, the stock market is so complicated. The stock market in particular, so well followed. I think that it would be a mistake for casual investors to look at fundamental research. Honestly, I think for most people, it's a gigantic waste of time. Unless it's like a passion of yours. So I'm not talking to you. If you love this, then by all means. But to think that you're going to power up Yahoo Finance, right, and look at the price to earnings ratio and think that there is any signal, let alone information in that, you will learn a hard lesson very, very quickly. So I mean, listen, obviously I look at the economy, I look at inflation, I look at interest rates, I look at stocks way too often. They're always on my screen. I'm addicted to the game, but there's not like one thing that's like a hidden gem hiding in plain sight that you should be aware of.
You wrote this interesting piece about index funds, and that you entitled that could be like breaking the stock market. Break that down a bit for us.
Yeah, so there have been a number of pieces over the years criticizing index funds. There was a magazine cover, somebody said like index funds are worse than Marxism. Index funds are, for most people, a great way to invest. And I don't even like getting into like the active passive debate. It's just like pretty stale at this point.
Yeah.
I think that people should invest. And if you want to invest in mutual funds, fine, great, wonderful. As long as you invest, I think that's the most important thing. So I think that this is a fight for nerds. Whether or not, again, your mutual fund outperforms by 30 basis points, underperforms by 90, if you stay invested over the long term, you're going to do just fine.
Yeah.
All right. So getting back to the question at hand, like what are index funds doing to the market? I would say it's really like what is a 401k? What are automatic deposits into the market doing to the market? I think it's fair to say that they are contributing to higher valuations. Whatever metric you're looking at, valuations are higher than they have been in the past. Again, for good reason. Doesn't mean it's bubbles.
But there's money coming from all over the world into the market too, right? Into the U.S. market.
All over the world.
The rest of the world's market is not like the U.S. market.
No, and the rest of the world is investing in the U.S. market.
Yeah.
Like UK investors have more money in the S&P 500 than they do in the FTSE, for sure.
Yeah.
So I don't think that index funds are breaking the market or distorting the market. Now, they are absolutely impacting the market in certain areas, like when a company is about to be, when traders have an inkling that a company is going to be added to the S&P 500, the price goes up before it gets added, and then it comes down once it's in the index. So is that impacting things? For sure. But is the market as a whole distorted? Listen, mutual funds, a lot of them, they're closet index funds. Like that's what they were.
Yeah.
They're closet index funds charging 20 times the price. So if you're going to get index like returns.
What happens when like these funds own, collectively like extremely high percentages of these companies? Like, do the companies operate differently? I mean, if you're Vanguard, you actually like, it's just a very weird thing. Like if they're voting for something, like if it's something that like helps, let's say you're in all the airlines and something that helps like one airline but really hurts the other four, that's actually like bad for you in a way. Like you want them all collectively to do well.
So I think that you just hit on a really interesting aspect of it. That's the part that is highly impactful is the companies, these Vanguards and iShares, Vanguard, BlackRocks of the world owning a large percentage of the companies. By the way, just for the listeners, that's us, right? Vanguard, BlackRock, that's you.
Yeah,
that's not like some maleficent corporate America. That's index funds. That being said, they vote on your behalf. I guess what Vanguard would say is, well, who better to be a large shareholder than this very, very long-term capital, right?
Yeah.
Like they're buying, they're holding for better or for worse. So I don't know enough about corporate governance to really say like, do you really want Vanguard voting on behalf of America for these companies? That's just outside my lane. But for sure, that's a legitimate area where people could say, all right, maybe this is, I don't know. But the thing is like, it's gone too far. Well, what do you do about it? Do you force people out of index funds? Like,
right, exactly. Yeah.
So I don't really know what the answer is.
And also,
I will say that
do you say like
going up.
one fund, like at some point, like Vanguard can own, like if Vanguard or BlackRock got so big, they could own 20-30% of these companies. Like at some point, like they have to cap, and then in some ways you're capping the Vanguard business because they can't own more than a certain percentage of, and you just have more index funds, or I guess.
Yeah, I don't know what to do about this trend, but index funds past they're more than half of all assets under management, and it's going higher. Now, you could say like, if this gets to a point where there's more passive price takers, then price setters will step in.
Yeah,
I don't know.
Maybe they'll do better, or maybe it'll be a better. Who knows?
I don't know. I think that you need much less price setters than maybe conventional wisdom believes.
I'd love to get your thoughts on fintech. Like in some ways, I feel like it's been a lot less disruptive than most people predicted. Like, why didn't fintech disrupt more of these legacy players?
Such a good question. My friend Howard Lindsay has written a lot about this. There were such high hopes that fintech would maybe eat the bank's lunch is way too strong, but have some influence. And you're right, they haven't. And why? I don't know if it's lobbying, if banks are too entrenched, if there's too much at stake. I don't know, but it still seems like a lot of the things that we were hoping to be able to do, just basic stuff in terms of moving money quicker and more securely, that really hasn't come to fruition.
Even maybe a lot of it's been like the big banks would have to I don't know, respond with better UI, but their UI is still horrible. Like
Hasn't
it's
happened.
just like the customer service isn't that much better. Like you would just think like they would, but they're still super entrenched, super profitable. Like people are not leaving them.
Yeah, so neobanks are obviously a lot larger than they were in the past, but there's just, I don't know if it's because a lot of the wealth is still concentrated by the boomers and they're still, happy to write checks and go into bank branches. But as a whole, and as far as, an investor perspective, there's been pretty lousy returns on the venture side investing in fintech. The big winners notwithstanding.
Now, there's a narrative that venture capital over the last decade went from kind of an investment business to an asset management business, and where a lot of the deals are really just consensus and more of assembly line. Like, how do you think about that?
That's exactly what happened. And the good news is that we're on the other side of that. I don't need to name names. You know who they are. The hedge funds that were providing growth capital at the Series F round, right? That were just writing $3 billion checks or whatever it is. They're gone. No, they're not gone entirely. But if you look at Logan Bartlett from Red Point Ventures, just put out a great deck on the state of things. And one of the slides that he shared was he called them tourists. And the amount of money they're allocating is, I don't know if it's 80% off the highs, but it's a very small fraction of what it was. So they were definitely causing the music to play a lot longer than it probably should have, forcing a lot of people to dance a lot quicker and looser than they wanted to,
distorting prices.
Yeah, and now the balance of power is tilting a little bit back towards patient capital, back towards the founders. Investors that didn't have to write a check in 40 minutes.
That was a pro-founder thing, right? It was.
I'm sorry. Right. Back to the other investors.
Yeah. It's interesting because valuations, as an investor, valuations are still incredibly high. It doesn't seem like it all over the tech sector. Series A, Series B, Series Seed. The seed deals, YCC deal is getting done at 25 million pre or something. Like it doesn't seem like we've seen a lot of changes in some of these things. There was a brief time where it came down, but it was very, very brief.
So I run a small venture fund. We invest mostly in wealth tech deals, and I think that companies that take too much money are shooting themselves in the foot. Right? Sure. I think they get attracted to the high valuation. Obviously, it's a nice little trophy. You get the announcement, but what happens next? If you can't grow into that valuation, you're out of business, right? So I had somebody saying to me like, "Hey, I've got somebody who wants to talk to me at 55. I've got somebody that wants to talk to me at 30," and I'm saying, listen, all else equal, I think a lower valuation, given where this company is in their life cycle, makes sense. Because if you can't really scale quickly, there's not more money behind that 55.
If you're an entrepreneur, why would you ever? I can see why you would take less money. That kind of makes sense. But why would you take it at a lower valuation?
Because so the money that you raise on that round, if you need an extension or you weren't able to deliver it or deploy it or get to where you need to be, you're out of business. So at a lower valuation, maybe you'll get an extension, maybe you get more money. If you raise at too high a valuation, you're
because you think psychologically, if you again you have 30 million and 60 million, you raise it at 60, then later on it's really worth 30. Psychologically, it's too hard to take a down round or something.
Yes, exactly, and not just psychologically, but investors aren't interested in that. There needs to be room for investors to make money.
Got it. So you think like you're just kind of like it just makes it harder, but like most entrepreneurs think it's only going to go up. Like they don't. It's kind of like almost like in their DNA to think that.
Yeah, I think that 2022 sobered people up.
Yeah,
and also in that Logan deck, he showed that the valuation premium for private to public companies is coming way down, and it got so out of control. It got so out of control. I was seeing deals. Pre-revenue at 100 get filled ultimately at 25 or 30.
Yeah. Interesting. Now, we've seen, Carta ran this like marketplace for secondary shares in private companies, and they just kind of like exited the market for that. but it does seem like a good idea. Like, do you think it's going to be easier or harder in the future for people to trade their less liquid private shares?
Easier. Uh, Companies are, this is not news to anybody listening. Companies are staying private for longer. And if you've been at a company for 8 years and a lot of your wealth is tied up in this illiquid stock,
Yeah,
doesn't mean that you're bearish on the company. But for goodness sakes, if you want to take out
you want to buy a house.
15% to buy a
Yeah.
house or pay for a wedding, then absolutely you should be able to get liquidity. And I think the market is going to supply that liquidity.
Yeah, yeah. But it's in the past, it's very cottage. I remember one of the best deals I ever did was this guy who needed to buy a home. He was at a super great company, and he sold me 15% of his shares. It worked out great for him. But it was just like very cottage. Like, I just kind of found him through a friend, and then it just was like, it's like there wasn't like there wasn't like easy price discover. It wasn't easy for me to find him. It wasn't easy for him to find me. You would think a better marketplace would solve a lot of these things.
Yeah. I know that there's an announcement, I don't know if it was 2 years ago, but I think it was JP Morgan, NASDAQ, and Citi, and maybe a few others are building these secondary markets. So it's a little bit outside my lane, so I can't speak to the specifics of it, but I would believe that there's going to be more in the future, not less.
And these companies, like, they're very worried about who gets on their cap table.
Sure.
Totally understandably. And if they have too many people on the cap table, it might lead to, some other, it might lead to a lot more regulatory things.
Yeah, no,
happen.
It's complicated.
What do you think? What effect do you think like new investors in this kind of like general private equity asset class are going to look like? Or are we going to have more investors in the future? Or are we going to have fewer investors? Like, how do you think about that?
There is a lot of demand for private assets these days. CalPERS just announced, or was it CalSTRS? I can't remember. The giant pension fund just announced that they're putting even more money in. Private credit is all the rage right now among asset managers and wealth managers. So the impact of more money into any asset class is higher valuations. And you've seen that over time. One of the reasons why private equity used to be able to easily, using air quotes, outperform the S&P was they were paying significantly lower multiples and using a lot of leverage, and that's a great formula.
Yeah.
And now the valuation
high competition for these assets.
Yeah, the valuation spread between private and public is a lot narrower than it used to be. And so that is ultimately going to lead to lower returns. I don't see how it doesn't.
What you made this really great blog post where you made these like out there predictions for 2024, where kind of a quarter into 2024 now as we're taping this. Which of those are you still super bullish on, and which of those do you wish you want to revise?
Feel pretty good about some of them. I think so far so good. So I predicted, and this, I think I wrote that this was going to be the one that aged the worst quickest, because I said that the streamers were not going to merge, that Paramount, Warner Brothers, they were not going to bail each other out because they're both in a lousy position. I still feel pretty good about that. I think, what else did I say? The stock market was going to gain 20%. I think I said something like that?
I think so, yeah.
It was up 10% in the first quarter.
Yeah.
Again, we'll see. Now listen,
yeah, we'll see. Yeah,
I should say all of these predictions, I said Bitcoin was getting 100,000. I think I said that. All of these predictions were sort of, it was me having fun. I don't invest this way.
You're being provocative.
Yeah, exactly. I think for next time, I'm going to put like the gambling odds on it. In other words, how much conviction do I have in this? So like the stock market gaining 20%, I probably would have put that at like, I don't know, plus 270. Right, I'm just making it up. So next year I'll do that just to give listeners or readers a sense of how much conviction I actually have on this trade, or this prediction.
Yeah, I like that. That makes it more fun. Yeah. And then people could at least argue with you on the odds or something like that.
And this way I can say, well, it was plus 1,100. Come on, this was a long shot.
Exactly. Now you released a book. I think now quite a long ago, which I really loved, called Big Mistakes. And what I really liked about it is you really talked about like the best investors of all time. You didn't like go for like the terrible ones. It's like these, and then here's some huge mistakes that they made. So you two, mere mortal, like be okay when you're making these types of mistakes. What do you think are like the commonalities of the mistakes that people make, even the greats like Warren Buffett?
Probably the biggest one is overconfidence. I've seen this movie before. No, you
Yeah.
haven't. Right? So it's overconfidence. And it's interesting, what sort of commonalities, what did people take away from this? It really is all over the place, because some people said, I'm going to change my style. I'll never do that again. Some people said, I knew I was making a mistake at the time. Like Stanley Druckenmiller said, well, what did you learn? And he said, nothing. I knew it was dumb at the time.
Yeah.
I just couldn't help myself. And to that specifically, he's one of the greatest to ever do it. And he went all in on the tech bubble at the peak.
Yeah.
Others were carried out.
By the way, which is like, we all can relate with. We've all done stupid stuff and we knew it was wrong at the time, and somehow we still did it. Like, it's so human to do that.
Yeah. So Michael Steinhardt was one of the biggest hedge fund managers in the 70s, really one of the pioneers, along with Julian Robertson and Soros. And his mistake ended his career. He packed it up.
Yeah.
And so, listen, I think the thing that I was trying to give to the readers is that it's okay to make mistakes. Investing is really difficult, but it's important not to make a mistake that's going to bury you.
Yeah.
That's really the thing. And so if you
it's
do
like
something
the
bad,
LTCM mistake is a mistake that is gonna, it's like a compounding mistake that's gonna bury you.
Yeah, it can't come back from that. There are certain things you can't come back from. Selling at the bottom in March 2020. Those are the type of things that you have to avoid. You have to avoid that. If you buy NVIDIA now and it goes down 20% and you sell, fine. That's, if you risk half percent of your portfolio, life goes on. You're gonna do dumb shit and lose money, but don't do it. Don't do it with leverage. Don't do it with all your portfolio. Don't go all in on anything after a 300% run. That's the type of stuff that you absolutely can't recover from.
Yeah. In some ways, it's just like having the right Kelly criteria in a way to actually allocate your portfolio accordingly.
And I think everyone's got their own a mental or financial line in the sand that they can't go over. And the only way to know where, and it's personal, my line is different than yours.
Yeah.
The only way to find your line is to take a step over it. And so we learn through mistakes, right? And the better, the early you make it, the better off you'll be. Obviously, less money is better than making it, in your 50s. And so that's the journey that every investor eventually goes through.
Now, we make investing mistakes. Everyone makes life mistakes. What do you think if you had to write a book almost about people's life mistakes, not money mistakes, how would you write about that? Obviously, people marry the wrong person, or they, I don't know, they get involved with the wrong crowd, or.
Yeah, so many life mistakes. I mean, I'll just speak to me personally. I had this weird, irrational internal confidence in myself that everything would work out fine. I don't know if I was born with it or that's just my natural disposition, and not even just to me specifically, but I'm not really a worrier. Everything will be fine. Everything will be fine. And that's how I treated
and you live in New York. I mean, you're completely out of place.
That's how I treated my education. And guess what? It wasn't fine. Everything was not fine.
Yeah.
I got kicked out of college twice because I thought that it would be fine. I thought that I could just show up to class and take the test and be fine, and it wasn't fine. And I learned at 20, whenever I graduated, and I'm not even really joking around here when I said, "Oh, this is why those nerds paid attention in school." I know it sounds beyond idiotic that I didn't I just didn't think about it. I thought I would be fine. And when you graduate into a financial crisis with a shit ass degree, with no skills, with no prior work, it bit me in the ass. So I don't know if that's a combination of procrastination or whatever it is, but that was a mistake that I made that I definitely paid for.
Well, one of the things, so many people that I've talked to on this podcast are late bloomers, not particularly good at school, maybe later got this passion later for learning. But I have this belief now that there's so many potential late bloomers who never were given that opportunity. They never actually were able to bloom because of different things that hit them in life, or they didn't have the right support system. Since you're kind of a late bloomer yourself, what are your thoughts on it?
Oh no, I'm not kind of a late bloomer. You described me. If circumstances didn't unfold the way that they did, I could have been working I could have been
fast
working.
food
No,
at, but
yeah, whatever. I don't want to even like
Yeah.
disrespect anybody, but I could have. I really was that close to just throwing in the towel. So like Tim Urban has a great like your life
Like
could
the
have taken a million
weeks.
different paths, and like
Yeah.
you are
Oh.
here
Oh yeah.
with
Yeah.
just a million
Yeah.
different squiggles. So I landed on the right squiggle. I was a late bloomer. And I didn't discover my passion in life, which is the markets, until 25, 26 years old. I made $415 my second year out of college. Like I was deeply, profoundly screwed. The only reason why I was even able to remotely support myself is because when I got kicked out of college and I was at home, I was working full time as a waiter for several years. So I saved up some money to cushion myself. But I also, I think that being a late bloomer has served me very well in life because I so deeply appreciate where I am professionally. I don't take any of it for granted. When I say that like things could have gone very different for me, they could have gone very different for me. So for me, it's a blessing.
I believe there are like millions of people who are like you, and because like I don't know, a lot of 17-year-olds are just dumb. Like they just, they're just doing their thing, and like that's what it's like to be sometimes 17. And not everyone's like on it and like has like the to-do lists and everything at that age. But like, how do we harness that potential of those people?
Man, luck is luck. And you're right. There are millions of people that never. So I met Josh Brown at the train station, and he threw me a life vest. And you're right. Millions of people don't never meet their Josh Brown, and it's a shame. I don't have any great fix for one of life's most difficult problems. But
so it's just dice roll.
I'm one of the lucky ones. I think like general advice for like how to expand your surface area of luck is to put yourself out there.
Take more shots at goal.
Yeah, just take more shots on goal. Really, like don't send the resume. Like walk into somebody's office with a resume.
Yeah. All right, this has been great. We have two questions we always ask all of our guests. What is a conspiracy theory that you believe?
Oh man, I read that in the doc and I forgot to think about it. All right, this is the first thing that comes to me, that the CIA was involved with Kennedy's assassination. Is that even a conspiracy theory anymore? I feel like that's pretty...
so many people say that, which is so interesting. It's like, it's such an interesting, it's like ingrained. I mean, I don't know, like, I don't know that much about it, but like, I love that it is like in people's head. Like, it's a fun thing to talk about.
So I know this is literal fiction.
Yeah.
But the Stephen King book, 11/22/63, was a fun read.
I haven't read it. It's worth reading.
Yeah, it's fun.
Okay. When I was a kid, I watched like the JFK movie. I was like, "Oh, this is amazing! Like, it's so great."
I'm not a conspiracy theory guy. I feel like they're so compelling because we're so like hardwired to believe that shit, and oftentimes they're just so dangerous. So I stay away from that.
You don't have any conspiracy theory about like the markets, like people manipulating the market. There's obviously all these Bitcoin conspiracies and other types of things.
No, I think the world. You know why? People are deeply uncomfortable giving into the idea that a lot of the world is random and outside of our control. We have to think that there's a them, a they. And I just don't, I think that, are there things that we don't know about where there's, of course there is. I'm not naive, but I think that there's far less than a lot of people believe.
I mean, sorry, I another question, because you seem to just generally have a very optimistic demeanor. Like, why do you think that is? And Daniel Kahneman recently passed away, and he has this very famous quote that if you could wish like one thing for your child, it's that they're optimistic.
Yeah, it's balanced optimism. I had, so as an investor, I'm always nervous.
Yeah.
So I'm not like a wild bull by any stretch of the imagination. I don't think that people should go all in on like, right. Like I am very, very cognizant of risk, but I think it's my personality. I grew up in the same house as my siblings, and they are not all like me. So I would say like it's the love that my parents gave me, but I don't know. I think a lot of it is just you're born with a certain personality, for better or for worse.
Okay. Interesting. All right. Last question we ask all of our guests. What conventional wisdom or advice do you think is generally bad advice?
I'm gonna give you an answer through the prism of generally accepted market wisdom. Buy low, sell high is horrendous advice. And the reason why is it's simple. Stocks that are going down for a reason. You're not a genius. there's usually, and so there is just a graveyard of people that are fishing on the 52-week low list. That is horrendous investment advice.
Okay. I like that. Yeah, incredibly hard to do. Obviously, we'd all love to do that, but incredibly hard to do. In some ways, also, my biggest mistakes in life are also selling too early.
Of course.
It's like, okay, well, then there was another X that I could have got, or another multiple X if I just waited. Well, this has been awesome. Thank you, Michael Batnick, for joining us on World of DAS. I follow you at Michael Batnick on Twitter. I definitely encourage our listeners to engage with you there. This has been a ton of fun.
Thank you so much for having me. I appreciate the time.
Thanks for listening. If you enjoyed the show, consider rating this podcast and leaving a review. For more World of DAS, and DAS is DAAS, you can subscribe on Spotify or Apple Podcasts or anywhere you get your podcasts. And also check out YouTube for videos. You can find me at Twitter at Auren, that's AUREN, Auren, and we'd love to hear from you.